My insurance isn't free, but I'm not paying for it. Uncle Sam indirectly is. In this episode, I'm going to show you how to redirect tax to pay for your life insurance. So my name's Doug Andrew, and I've been helping people optimize their financial assets, minimize taxes, and empower what I call their authentic wealth now for more than 4.5 decades. And as I teach you how to redirect otherwise payable tax to causes you support, like having insurance being paid for with otherwise payable tax, at the end, I want to gift you a free copy of my most recent best-selling 300-page book. It's called The Laser Fund. We're going through hundreds of these books every 2 days. And so I want you to claim your free copy. So stay with me. And I want to enlighten you on why I think this is so important for you to be able to accumulate, access, create tax-free income, and when you ultimately pass away, let it blossom and transfer tax-free to your heirs. It is what I call the Laser Fund. So I started in 1974 and I helped many thousands of clients. In fact, by 1980, I was responsible for over 3,000 clients in 13 Western states. And I began to show them how to be able to redirect taxes to cover themselves for life insurance so that in essence, Uncle Sam indirectly was paying for their insurance. How do you do that? Now, nothing's free, but I don't pay for my insurance. But first of all, I want to make sure you understand that we don't object to insurance benefits, do we? See, I've never had a widow or a widower turn down an insurance check. I've never delivered $1 million death benefit and had a widower or widow say, "Oh, no thanks, I don't need the money." No, we don't object to the benefits, we object to paying for it. In fact, if your employer came to you and said, "Hey, we've had a banner year. We're going to offer some additional benefits for everybody. Free life insurance. How much would you like?" "As much as I can get?" "Yeah." See, we don't object to insurance benefits. We object to paying for it. Now, if I can redirect otherwise payable tax to get insurance at no cost to me, I'll take as much as I can get. Does that make sense? So why is life insurance tax-free in the Internal Revenue Code? Well, it's been a sacred tax-free cash cow for over a century, 107 plus years to be exact. And it's because when people insure themselves so that if they happen to pass away in an untimely death, they want to leave behind the wherewithal to allow their spouse, their children to continue with the same goals, music lessons, education, so forth, that they would have provided had they stayed around. And so the government says, you know what, this is taking pressure off of us as government to provide welfare benefits and so forth. And so we will not tax life insurance, not only on the death benefit, but also on the money that grows inside of an insurance policy if it's a permanent life insurance policy. So it will accumulate tax-free with the interest and the dividends. And if you want to use it for living benefits, it takes pressure off of the government to have to help out people with Social Security benefits and what have you, because people outlive their money. And so they've allowed it to be sort of a sacred cow, where if you accumulate money inside of an insurance policy, all of the growth is tax-free, you access the money tax-free, and when you ultimately die, it blossoms in value and transfers income tax-free. Nothing else in the Internal Revenue Code does that. So we use it more for living benefits than for just the death benefit. And this was actually the brainchild of E.F. Hutton clear back in 1980. They were not an insurance company. They were a brokerage firm. Let me share with you what happened back in 1980. But before I do that, if this is intriguing you, be sure and share with somebody who might also appreciate watching this education. Click like, subscribe to the 3-Dimensional Wealth YouTube channel. I post an in-depth answer to a financial question almost on a daily basis. And stay with me to the end because I want to gift you a copy of my most recent 300-page best-selling book. So clear back in 1980, basically E.F. Hutton said, you know what? Instead of trying to have people make money in the market, even though they were a brokerage firm, golly, the market goes up, it goes down. For conservative people, why don't we just bypass all of that volatility and have people put money into insurance companies? Because the multi-trillion-dollar insurance industry is not only the backbone of America, but the backbone of the world. This is where governments go to for help when they get into trouble. This is where one insurance company that I put some of my money in manages as much money as the IRS collects in taxes in an entire year. This is where banks and credit unions take your money that you deposit in the bank. See, when you really think about it, there's only 4 things you can do with money. You can spend it, you can lend it, you can own with it, or you can give it away. But when you put your money in a bank or a credit union or an insurance company, it's in a lended position. Have you ever thought about it like that? You are loaning them your money. Are they just a benevolent institution paying you interest? No, it doesn't sit in some vault. What do they do with your money? They loan it back out again at higher rates than they're paying you. But do you know where banks put 30 to 40% of their tier 1 assets? That's money they have to have on hand, liquid and safe in case of a major catastrophe, a run on the banks. In 2008, the federal government asked the 5 major banks in America to disclose where they had their tier 1 assets for liquidity and safety. It was in insurance companies, oftentimes in BOLI, B-O-L-I, which stands for bank-owned life insurance. What? Yeah, banks own life insurance. On who? Their boards of directors, their stockholders, whoever. It's the owner of the insurance policy that gets all the tax-free growth and tax-free income. Okay? Banks own these. Do you know where corporations put a lot of their money? COLI, C-O-L-I, corporate-owned life insurance contracts. Because it's the only instrument in the Internal Revenue Code that allows you to accumulate your money tax-free under Section 72E ever since 107 years ago. You can access your money tax-free under Section 7702, and when you ultimately die, it blossoms and transfers tax-free. Nothing else does that. So a lot of people who are savvy, they use it for living benefits. Long story short, for the last 4.5 decades, I've been earning rates of return between 7% to 10 and 11%, probably averaging 9.6. Now, if you earn 9.6%, your money will double about every 7.5 years. So I've had many people who started out with 100,000 and it doubled. 500,000. 500,000 doubled in 7.5 years to $1 million. Another 7.5 years, in the 15th year, it was worth $2 million. In another 7.5 years, in the 22nd year, it was worth $4 million. And in the 30th year, it had doubled again to $8 million. Yep. People started out with $500,000 in their insurance policy. They have $8 million now, generating between $640,000 to $800,000 a year of tax-free income. I think of one couple in California that has that much, and they only need $300,000 a year, but they're earning more than double that. They will never outlive their money. But a lot of their friends and family members chose to keep their money in traditional IRAs and 401ks, and they will likely outlive their money because it's being eroded away with taxes and now inflation and market volatility. With indexed universal life, you're able to participate when the economy goes up, the markets are up, but not lose when it goes down because your money is safely tucked in the insurance company, and you can link your return to what the market does without your money being at risk in the market. You need to understand how this can benefit you. So, how does all this come together? Your money can double every 7 to 10 years based upon historical averages. I can't guarantee that in the future, but based upon the past, golly, it doesn't matter what you begin with. You can sock away $500 a month, and in 30 years, you'll have $1 million nest egg that can generate $70,000 to $100,000 a year of tax-free income. My 2 sons co-authored a book with me, Millionaire by 30, How to Have Your Money Earning More Than You Do by Age 32. If you understand how to do that, your money can be earning more than you do by age 32 by following these principles. But see, my favorite vehicle I call the Laser Fund, which is a max-funded indexed universal life insurance contract. So when we connect all the dots here, I've been earning many years 11% netting 10, 10% netting 9. If I earn 11 and net 10, what's that 1%? It's the cost of the insurance that the IRS says has to be there, or it will not be tax-free. It will move from tax-free insurance in the Internal Revenue Code over to taxable investments, a different section of the code. No, I want to be sheltered under the tax-free umbrella of insurance. So I have to have insurance attached, but it's not a cost. When I look at it, nothing's free. See, that 1% would be money that I would be shelling out in unnecessary income tax if I had my money in IRAs and 401ks. I would have to be earning 15% in a tax-deferred IRA or 401k to be able to net 9 or 10% after paying the tax at the end of the day on my IRA and 401k distributions. But the sad thing is, most people's money in IRAs and 401ks in retirement is only earning about 3.5% to 4%. You pay tax on a 4% payout, $1 million nest egg in IRAs and 401ks, giving you $40,000 a year of retirement income. Before tax, you're netting 3% after tax, $30,000. Max funded indexed universal life, if you earn 10 and net 9, you're earning 9% net. Uncle Sam is paying for the insurance under that illustration. It's not free, but I'm not paying for it. How much more is $90,000 a year of tax-free income than $30,000 a year out of an IRA or 401k portfolio after tax? It's 3 times as much money. It's 300% more. If this is intriguing you, would you like to learn more? I'd love to gift you a free copy of my most recent best-selling book. We're sending out hundreds of these almost daily, and I don't want you to miss out. So if you go to laserfund, laserfund.com, or click below on this link, you contribute a nominal amount towards the shipping and handling, and I'll cover the rest of that cost, and I'll pay for the book. I'll fire it out to you, and there's also other options in there for some of the other books if you like to learn. You can use the audio version if you like to listen and learn. There's even an 18-hour masterclass that we teach this in depth, because this will teach you how to diversify and create the foundation for a tax-free retirement, and how to have Uncle Sam pay for your insurance indirectly by getting better rates of return and having a minuscule portion of money pay for the insurance that would otherwise go out the window in unnecessary tax. Does that make sense? Are you on board? Get on board by studying and becoming empowered with knowledge.